about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
We are all unique. Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
It's going to be very important to make sure that if we're going to go through a period of pain, we do slay the inflation dragon.
Larry Summers there, the former U.S. Treasury Secretary on Wall Street Week with David Weston from New York City this morning. This is Bloomberg Surveillance. A good morning to you. Your equity market positive by 0.5% on the S&P, on the Nasdaq 100 up 5 or 0.6%. Big week of gains, TK, behind us. We add to them this morning.
Yeah, right on. It's just as if the weekend didn't exist. And again, there was a quiet in the research through the weekend as maybe people reset for the end of the quarter, end of the first half of 2022. Let's get right to it. The G7 meeting, Maria Tadeo and Anne-Marie Horton together. This is in Munich, near Munich, I should say, southern Germany, right on the Austrian border. Maria, let me go to you first. And I think it's so important that, yes, there's a war in Ukraine, but to me, this is a G7 overwhelmed by domestic realities. Macron, Scholz, Biden, and the rest absolutely overwhelmed by the politics of each nation.
Tom, I'm going to push back on that a little, because when you go to a gathering like the G7, there's almost this unspoken rule that your domestic issues, you leave them aside. As you say, there's a lot of issues for everyone here. Emmanuel Macron had a bad election 2 weeks ago. Boris Johnson, of course, he goes from scandal to scandal. And then, of course, we know that the president in the United States also has his own issues. But I think when you come to a gathering like the G7, that's very much the language that we've had over the past 24 hours. It really is about the international, and it's about presenting a united front. And I would argue they have been successful at that. They just had a communique put out 30 minutes ago that says we're going to support Ukraine. That was a goal, and we'll do it for as long as it takes.
Estonia, Latvia, and Lithuania are not part of the G7, but they're front and center, Maria. Off of your interview with the president of Lithuania, please tell us how the G7 looks at the beleaguered Baltic states.
Look, Tom, I think we're about to find out tomorrow when everyone who's here gets on a plane and goes to Madrid. Of course, my hometown. This is going to be a very important NATO meeting for the Baltics, for the Eastern Europeans. And if you ask me, it will be more important in terms of the content and the substance than this G7 has been. A lot of this is just prepping the ground for NATO. And if you ask officials, they tell you the most important thing yet to come is that NATO meeting that starts tomorrow in Madrid. I think we're going to hear a lot from the Eastern Europeans to say It's not just China. Let's focus on Russia. That is the most immediate threat, and that's the focus when it comes to deploying troops, but also changing the NATO strategy. There will be a lot of focus to reshape it, not just in China, but actually now really focus on Russia too.
And Maria, in the conversations that you have with people at these meetings, how much is there a feeling that America is back, to use the phrase that Joe Biden put out there, post-Trump years, that the leadership role of the United States is very much still present?
Well, that's how the U.S. officials would like to describe it, and that's how they did at the past G7 in Cornwall. But there is a lot of anxiety amongst European leaders that there will be a big shift, not just in November with the midterm elections, but potentially in 2024. And they just don't know what America they're going to get. Are they going to get an America that wants to engage on a multilateral front and combat issues together and collectively? Or are they going to want to get America that goes it alone? And while the U.S. will not discuss this, and European leaders really won't say this publicly, that is the concern behind the scenes.
How much are European officials willing to pony up cash in order to back up their new leadership, or their sense that they need to really step up? We saw that certainly with the military support in the face of the Russian threat. But on a broader sense, with Belt and Road and the potential initiative to combat that, how much is there real willingness to put money into that?
Well, they tried this already. President Biden pitched this at the last G7. It was called Build Back Better World. It's getting a rebrand, a little bit of a PR pivot, and they're trying it once again to coalesce G7 leaders to come on board. President Biden says that collectively there will be $600 billion, with the U.S. leading away, $200 billion. But there's still a lot of questions about this. How much are each countries going to be able to cough up when it comes to public versus private sector? Where exactly is all that money going? European officials at Build Back Better World, the last initiative, which has now been rebranded, we're asking questions about how much can the U.S. actually do when they've also failed at home to get some of their initiatives passed through Congress.
And John, help me here. I mean, Maria Tadeo, as we move on to Madrid, I mean, topic number one in Madrid is they're going to be without Gareth Bale. I mean, he goes to Los Angeles, not to Cardiff and that. But Maria Tadeo, is Real Madrid the same Real Madrid it was a month ago?
It's better, Tom. And don't forget, a month ago, Real Madrid won the Champions League, a record no one else has done. So we're going to get a new stadium. So if you ask me, it's not just the same Real Madrid, which is always great, but this is going to be even better.
I think Marie's more excited about that, Tom, than this G7.
I think
to be honest with you. Maria Tadeo, thank you.
Oh, totally.
Maria can't wait to get to Madrid.
To you as well. Thank you to the both of you. Great coverage
She's
as always.
rubbing it in because she knows I was.
AMH
She's rubbing it in.
Something.
She knows I was rooting for Liverpool.
Is that right? The losing side.
Yeah, Maria's rubbing it in. She knows I was rooting for Liverpool.
You two should have your own show. Anne-Marie, Maria Tadeo, we'll catch up with you later. Thank you. TK, where did Real Madrid banter come from? Where did that come from this morning?
I spend all weekend trying to keep up with you. I mean, you know, Gareth's a big
That's
deal.
how you prepared.
I don't get the whole American soccer thing. I mean, basically, John, seriously, they go out and they hire older premier people who can't do it anymore?
With the branding, Tom.
Yeah.
They have the brand and they try and bring some eyeballs over. It kind of makes sense.
Does it work?
It hasn't worked as much as they would hope it would work. It started with David Beckham, but it goes back way before that, Tom.
Yeah, okay.
With Pele, wasn't it? Decades ago. Anyway, do you want to talk about the elephant in the room at the G7?
No, I thought it was a Dow quote.
It's the country that's not there. It's China.
Yeah.
On a whole range of issues, it's China.
To me, it's basically an allied meeting in a war against Mr. Putin. I mean, that's what this G7 has come down to.
Lisa, your view?
The discussions around China were fascinating because there is such a distraction with Russia. The fact that there were so many initiatives to build up some of the infrastructure away from China, to talk about committing more money into this competing initiative of Belt and Road, to me was fascinating. And that was the same thing at Davos. You saw the main headline discussions were all about Russia and Ukraine, but under the surface, it was all about China and the potential threat coming from there.
Germany has found itself as the weak link of the West's effort to do something about Russia, to do something about the Chinese Communist Party.
Exactly.
Chancellor Scholz has inherited that legacy from Chancellor Merkel. He's learning a hard lesson when it comes to Russia. There are big questions about how they will contain China and the Chinese Communist Party. And look at the kind of policies they're trying to come up with at the G7. A cap on Russian crude. Is China going to play ball on that, Lisa? I think we know the answer to that, don't we?
They're playing a very difficult game where they're both trying to isolate China and not necessarily poke the bear too much. And how do they do that effectively for the longer term?
Equity futures right now up 16. Big rally last week. It continues up 0.4% on the Nasdaq 100, up 5 or 0.6%. And yields with a bit of a bounce, up 3 basis points to 316. You will hear from Chairman Powell again this week from New York. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
From New York City this morning. Good morning to you on TV and radio. Here's the price action on the S&P. Futures positive by 0.4%. On the Nasdaq 100, up 0.5%. We're up almost 9% since the Nasdaq bottomed on June 16th. 2 days before that was when the two-year yield topped, at least for now. Let's check in on the two-year. On June 14th, 3.45. Right now, 3.08%. So we've come all the way in. Yields up on a session by a couple of basis points. But you're familiar with that story, that inverse correlation between where bond yields go and where equities end up. Fully understood, right? I think we've got to go further, dig deeper. Well, why are yields lower, Tom? Why are yields lower? Is it about the Fed backing away because inflation's going to peak, or is it about a Fed backing away because we've got a problem with economic growth?
We've backed away from where we were when you were on sabbatical. We had a 299 on the 2-year yield at one point, John. I mean, we dipped below it. It's sort of like Dow 10,000. It's an important mark.
You wanted to cut into this market check just to say that?
Yeah.
Thanks. All right. Let's finish on this.
299. We're back out 7.
I know. Yeah, I've missed you. All right, TK. Euro dollar looks a little something like this. There's no point me saying anything. 105.74. That's the cross asset price action. I'm going to let this go. Let's get you some stocks on a move, uninterrupted. At least we hope. Let's get to Romain Bostic.
Yeah, we'll hope. It was a wild week while you're out, John. Welcome back here as we get into the new week here. If you're looking for the type of breadth that we saw in Friday's rally, well, you're going to have to keep looking here. A breadth a lot lower here in the pre-market. You are seeing some of those big cap tech stocks get a bid here, like your Netflixes, your Teslas of the world. Apple shares up about 1% on the day. In fact, if Apple actually closes into the green today, it'll be the first 3-day gain that we've seen for the stock all month long. But of course, this is a month where Apple's still down 5% and down about 22% from that all-time high. A lot of the ADRs of Chinese tech stocks also getting the bid today. JD.com, one of the more notables, up about 5%. There are some company-specific issues there, but we should point out the broader market there over in China, particularly when it comes to some of the main indexes that track Chinese tech stocks. Now people are starting to talk about the return to a bull market. They're only about 1% or so away from that metric. And Micron shares up about 1% as well. Keep an eye on the semiconductors. Micron going to report after the bell on Thursday afternoon, a little bit later this week. Now, there are a lot of decliners here. In fact, decliners outpacing gainers here in the pre-market. Coinbase taking a huge leg down, 6% right now. This on a downgrade by Goldman Sachs, which says that they're expecting a lot more pain in the crypto space. And with the drop in crypto assets and the drop in volume, companies like Coinbase are really going to suffer here. Etsy also getting downgraded over at Needham. Those shares down about 2%. And keep an eye on Spirit Airlines. The shares down 5%. Shareholders have to vote on that big deal, whether they go for the Frontier deal or whether they go for the JetBlue deal. Frontier did restructure their deal, and apparently investors are not too happy about it. Tom, those shares down 5% right now.
Romain, thank you so much. To close, getting you started on this Monday, this afternoon here on Bloomberg Television and radio. Right now, and this is a joy, Camacho Trivedi joins us with Goldman Sachs. Out of Oxford, economics, global FX rates and EM at Goldman Sachs. And Camacho, it's just a great time to speak to you because I think we've underplayed EM dynamics. Many of the Pacific Rim EM currencies have really given way in the last number of weeks. I look at Thai baht pretty much on a daily basis, and we're not talking enough about the linkage of renminbi response to all going on around the G3. Explain the dynamic now of EM currencies and China.
Yeah, I think it's a great question. And I think what you're really seeing is China is in a very different place to the rest of the world. As you're seeing central banks across the world hike rates to slow their economy down, because of China's experiences with zero COVID and a much slower economic momentum, they're actually lowering rates in order to support the economy from these shutdowns. And that means that the carry advantage or the yield advantage that used to be in the case of the CNY relative to other currencies is just no longer there. And so China's in a very different place. You're seeing, pressure on the currency. We expect that to continue. And that's a big anchor currency for that entire region that you mentioned. And so, we would expect to see a number of these currencies underperform the dollar in coming weeks and months. Of course, there are relative value differences between them, but by and large, we'd expect them to continue to weaken versus the dollar, a bit like the CNY itself.
Camacho, this goes to an underlying angst about whether there's a spiral. Once a currency starts to weaken, you get more imported inflation and you have an economy that deteriorates further. And then there's even less impetus to buy into the nation. How much are we seeing that start to happen?
I think where you're really starting to see that happen is really in the tail of emerging markets that have significant dollar financing requirements. And so I look at the sort of credit space, and that's where when people ask me, look, you're seeing some of this big reduction of dollar liquidity in the world, where is the impact really occurring in EM? You have a number of high-yielding EM sovereigns that are just struggling to issue and come to the market. Market access is very impaired, and that's where you're seeing the real pressure. I think for some of the more, what I would call sort of major mainstream emerging markets, you're seeing the inflation impact, but not quite that sort of concern or about distress or sovereign credit. But I think you're beginning to see that in the tail of high-yielding frontier emerging markets.
This is incredibly important, Kamakshia, because we were speaking with Bill Dudley, the former New York Fed president, last week, and he was talking about how if you start to see financial dysfunction, it will be with emerging markets, particularly those that you're talking about, and that it could spread some distress. How much are we starting to see that with the likes of Argentina, with bond yields for local debt upwards of 70%, basically pricing in yet another default? I mean, are we going to see another default cycle in the very near term in the developing world?
I think we are. I think, and we have already started that. I mean, Sri Lanka is probably one of the first one that, has already defaulted. As I said, if I look at the numbers year to date, we've seen half the issuance that you would normally see by the middle of the year amongst that group of high-yielding emerging market sovereigns. And I think that tells you the degree to which market access is impaired. And so this is one of these situations where time is not your friend. The longer this continues, a lot of those countries are going to have to dip into either reserves or try and get loans from other sources. And so it's getting to be a pretty challenging place if you are a kind of high-yielding emerging market with a lot of dollar financing needs, currencies under pressure, and the world as a whole, seeing recession probabilities increase. That is exactly where you're going to see the pain points begin to manifest themselves.
Where is your pain point for the Bank of Japan? What's your calculated dollar-yen level where things begin to fall apart for their shell game? Is it 140 or is it a weaker yen?
I don't think that they have a particular point in mind, but I think the pressure on them is going to continue to grow. Obviously, inflation is much lower in Japan by global standards, but it's reasonably high in Japan by Japanese standards, especially in the case of recent history. But our view has always been that, to some extent, the real point where they'll feel perhaps comfortable moving away from the policy that they have in place is probably when U.S. yields have already peaked and are moving lower. So you don't sort of continuously see the pressure because they might, you don't keep seeing the ratcheting up of that effect. So I don't think there's a level. I think you're going to have to be a little bit patient to see that change.
Well, Kamakshia, to that point, have we seen that? We have had a number of investors come on our show and say that we have reached peak yields or we're getting close to that, and we're going to have this summit in Sintra in Portugal where perhaps they'll get together and they'll commit, these central bankers, to fighting inflation. Do you think we've reached the pivot point?
I think we've reached a point where the risks around the current level of yields is much more symmetric than it has been for some time. It's been a sort of one-way train, given that central banks were to some extent behind the curve when it came to fighting inflation. They've certainly, upped the pace, especially when it comes to sort of G9, G10 central banks. They've really upped the pace. And what that means is we've got to a place where, 3.25% of yields, you're at a point where the risk to that we feel are much more symmetric. I think it's early to perhaps say that we've already peaked. I think, we might still see some upside surprises in inflation. And, if recession is not imminent, I think these things can still push higher from here. But I think that it's fair to say that it's no longer the kind of one-way trade that it used to be.
Kamakshia, awesome. As always, Kamakshia there, Trivedi of Goldman Sachs. Thank you, sir. Just on China, just perfect timing here. Jeff Yu of BNY Mellon wrote to me just a moment ago across the Bloomberg and said this: we've had no inflation impulse from China for 6 months, if not longer. If Beijing suddenly starts pumping again out of necessity, then it could be a different story, Tom. He goes on to say not just commodities, but durable goods as well. There might be a sting in the tail. That from Jeff Yu just moments ago.
I strongly agree that it's the unexpected here, John, that's critical. It really stopped me cold over the weekend, some of my reading, I can't remember where core inflation in China and on the Pacific Rim is so dramatically lower than the 6 or 7% core inflation that we have, let's call it, in the Atlantic world. And I think it's really, really remarkable to see 0.9%, 0.8% core inflation away from the shocks that we're all going through.
We've got these rolling lockdowns in China, Lisa, and that's why it's been so difficult to understand and forecast. We thought a lot about it from the supply side because of supply chains from China out into the rest of the world, not so much about the demand side. And I think that's the point that Jeff's trying to make this morning.
But then longer term, I'm just trying to wrap
Sure.
my head around and extrapolate out what that means if you start to get an alleviation of some of those lockdowns. Do you get a rip-roaring inflationary impulse that comes back from the demand side, not only for oil, but also for goods and services, or do you get some sort of remedying of the supply chains? It highlights how difficult this moment is to really forecast.
And
as
what
you
it
were
means
saying.
for the Dow. This
Yeah.
is really important stuff.
For the Dow?
Really, really
Did you really
important
just say
stuff. I'm joking. Just waiting for him to cut in again.
Literally could
Just
walk
waiting for him
off
to just
the set.
to
I don't know
cut.
what's up.
You almost took me seriously then.
I was like, excuse me, did I hear you correctly?
I give up. Futures up 19 on the S&P. We advanced about a half
So
of 1%
quiet.
TK. He is quiet this morning, isn't he?
Yeah, well, the Tang's a little flat.
Bitter about how he spent his weekend. Where did you spend your weekend?
Oh, it was just a
Coney
joy,
Island.
John.
Sounds pretty special, Tom.
Yeah, it was really special.
What's your favorite ride?
I can't decide which
Can you imagine
ferry
Tom
to take
on a fairground ride?
On the Cyclone. Like, let's
John,
go.
do you go? John, seriously, do you go nonstop to Naples or do you go into Milan and drive down?
He's so bitter.
You can go via Rome, Tom, but I wouldn't suggest it. We can get a direct into Rome and work your transport out from there. Probably better. I think United do a direct into Napoli, into Naples, Tom. Out of my price
You're
range.
helping
Might
your
be in yours.
cause.
I'm taking air tuition.
I can tell you, Air Ita, which has replaced Alitalia, Tom. Impressive stuff.
Oh, really?
I can share some of that with you in a commercial break.
They on the
okay?
shuttle to Washington?
I think we're
That's
done
great.
here. Futures up a half of 1%. This is Bloomberg.
How much is
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A group of 7 nations are expected to agree on exploring a price cap on Russian oil. The goal is to limit a key source of revenue for Vladimir Putin for his war in Ukraine. Bloomberg's learned that a potential mechanism would work by imposing restrictions on insurance and shipping. And commodities are hitting powerful headwinds after a first half dominated by the supply turmoil and inflationary shocks. Bloomberg's index of spot commodities has fallen 13% from a record. Still, Goldman Sachs says prices haven't topped out yet. In a new note, Goldman analysts say that growth and demand are slowing down, but not falling. Frontier Airlines has written an open letter to shareholders of Spirit Airlines, urging them to vote in favor of Frontier's takeover this Thursday. Last Friday, Spirit said that Frontier's latest bid, which is mostly stock, is better than JetBlue's all-cash offer. JetBlue says its bid is, quote, decisively superior. Coming up at 11:40 a.m. New York time, we'll talk with Frontier CEO Barry Biffle here on Bloomberg Television. And in sports, the Colorado Avalanche won hockey's Stanley Cup for the third time in the team's history. Colorado beat Tampa Bay 2-1 to win the best-of-7 series 4 games to 2. Tampa Bay had won the last 2 National Hockey League titles. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
David, you just hit the nail right on the head.
from business's most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
2 days, just 2 days out of the market, and basically you've erased the majority of your per annum returns. And that's over, again, we've looked at a 50-year period. Now, sometimes people ask the question, well, what's the probability that I could actually pick those 2 best days and just be in for those 2 best days? And unfortunately, you're better off playing the lottery. So that is no longer an investment strategy. That is pure speculation.
Time in the market, not timing the market. The message from Kristen Bidley there, the head of North America Investments for Citi Global Wealth Management from New York City. Good morning to you. Futures up by 0.5% on the S&P, on the Nasdaq 100 up by 0.6%. Busy week for economic data. The ISM to close out the week in America. And we hear from Chairman Powell TK alongside President Lagarde and Governor Bailey sitting down with Francine Lacqua in Sintra, Portugal. I believe on Wednesday. Is it Wednesday, Bramo? I believe it's Wednesday.
Has there ever been a panel like that where there's been such a disagreement on the x-axis, the timing, the process of this all?
What a moment for that conversation, Tom. Absolutely remarkable.
I don't think so. How about the odds, John? You know, if you're at Bar Tabaki Giochi Elmo Zero in
crushing it
in Capri,
should I be offended?
And you know, you buy your ticket, John, as you did on the Super Inalato.
Oh dear Lord!
It's 1 in 622 million to win the jackpot.
Thanks for that. How long do you reckon you can keep this going?
I just think all week,
through the whole week.
Until the next time you go to Italy for a sabbatical. Never on sabbatical is Kriti Gupta here with an important chart on Mr. Putin's challenges.
Yeah, we have to take a little bit of a downturn because this is a historic moment, Tom, as we look at those bonds. Russian defaulting officially on $100 million of debt. This is their first default since going all the way back to 1918. So for my chart, they were looking at those bonds that they're defaulting on here, the 2036 that they did have 100 due. And I remember these bonds have been trading in distressed territory. So the idea that they defaulted as a result of those sanctions and, of course, people just not wanting that exposure to Russia, it is largely symbolic. But take a look at this. For our radio audience, since March, these bonds have basically been trading about 20 cents on the dollar. And remember, Russia has been saying it has the money. It's just been forced into non-payment, trying to service perhaps the debt in rubles. Of course, the Western companies not having it. Also keep in mind, this is the foreign debt and not the local debt. That local debt default was last in 1998. Nevertheless, Tom, a historic moment.
Yeah, I read very carefully this, and I agree. It's a challenge here. Maybe when they re-up someday down the road. But for now, it's what it is. It's in the price at 20 compared to 100, down 80% on a lot of that paper. Kriti Gupta, thank you so much. Joining us right now, always a joy, here on EM with hyper-detailed notes for Bloomberg Intelligence. Damian Sassower joins us, I believe, in London today. Damian, let me start with a Monday open question. Which part of EM is the part that our audiences should focus on?
Well, it's got to be Russia, Tom, and it's a very simple thing. This is definitely, this default has really been going on now for 3 weeks. The CDDC announced that basically a 1.9 million coupon payment was late, and it's been in deliberations now for 3 weeks determining how to pay out the CDS because, quite frankly, it can't figure it out. It can't figure out how to get a transparent market price for the CDS to settle at. So even though, yes, technically the country's in default today, this has been going on for 3 weeks, and it's going to go on for that much longer. There's 1.5 billion in the balance here, Tom, and nobody knows how to settle it. No one knows where the CDS is trading at the current price.
So, Damian, you said before the break, it must be a slow day if this is what we're focused on because it already happened. And to some degree, you're right. On the other degree, you're not. And this is the reason why, because it raises a question of whether this is dangerous territory for the United States to go after a nation and say, it doesn't matter how much money you have, we will not allow you to pay. Does this actually, has there been any signs that this has actually materially eroded the United States' position of the dollar as the funding currency?
I mean, Lisa, for me, it's more about the efficacy of the credit derivatives, the market for credit protection, quite frankly, because if they can't figure a way to hold an auction and find a clearing price, I'm talking a price that both the buyers and the sellers, the holders and the sellers of the credit default swaps right now can agree to. Is it going to be a cash settle, a physical settle? Are they going to go to a third-party marketing, a market pricing like China and India are trading these contracts, but they're the only ones. So, you know, how are you going to get agreement across this entire capital stack, across all the creditors, to find a price at which these, you know, at which the money can change hands? The verdict is still out, but that is the real test here of the credit market itself, Lisa.
Damian, how isolated has this issue been over the last few weeks, few months?
Incredibly. I mean, it's incredibly isolated. I've not seen anything like it. I mean, we all know, you know, they have the capacity and the willingness to pay, and they're being forced into default by the U.S., but are they really? I mean, they're the ones who chose to invade a sovereign nation, right? So, you know, that's what people are going to hang their hat on, but this is going to go on in courts for years and years and years. I mean, and quite frankly, just the fact that the CDDC can't hold an auction to find a clearing price for these contracts tells you everything you need to know about the credit derivative, the market for credit protection, Jonathan. It's at risk.
Well, Damian, talk to me about that. As we think about getting protection on bonds from other countries that might find themselves in a little bit of difficulty with the American government down the line, what does it mean?
So if it's a cash settlement, Jonathan, the way I see that is the buyers, the holders of the protection, they're going to get better pricing because they go right to their dealers and they say, okay, you have to make me a price. You sold me this contract. What's the price? Those dealers can't kind of match their book, so it's going to be very difficult for them to find a price. Or they can go to the physical market, in which case that would benefit the sellers of the, because again, that's a less transparent sort of way of doing things. Or they go to a third-party sort of pricing mechanism. These bonds or these are still trading in China and India, but how reliable are those prices? Because after May 25th, U.S. and foreign creditors really can't trade in them. So to find that transparent price, that real clearing price, is the critical issue here, and I just don't know how they're going to do it, quite frankly.
Damian, awesome to catch up, and no doubt we'll catch up with you before the weekend again. Damian Sassower there on a really, really fascinating case study that's playing out in real time, Lisa, in the bond market.
Especially because if you think about it, what's credit protection used for? It's for investors who want to, unless they're a short seller, offset their exposure to certain nations or to certain types of risks. So if you cannot effectively hedge that in the credit default swap market, how much do you just demand a much bigger premium on a structural level from a lot of nations that could be at risk of finding themselves in a similar position?
TK, we're in pretty original territory on several fronts with regards to this.
I agree with that. I agree that original's the right word. I mean, it's original across the board, and I'm really fascinated, John, at the adjustments we're going to see of the politics of the moment, the finance, the economics of the moment off the mid-year reports. John, if you wrote your mid-year report 3 weeks ago, can you publish that today? I don't think so.
Has it changed already, Tom?
Yeah.
On several issues, it may well have done. Lisa, when it comes to this and this Russian so-called default, there was always this talk about moving away from that dependency on the US dollar. it just hasn't happened in the way that people thought it would. We've been talking about this for a long time now. It didn't just start 3-4 months ago.
So this has been ongoing, and you have seen certain nations try to diversify away from the dollar, and they have not succeeded. And this really highlights how the U.S. does have this very dominant position. That's why when Damien talks about the credit default swap issue, perhaps that's the bigger one with implications, because the other one really hasn't come to fruition.
Do you remember when Giselle wanted to get paid in euros?
Yes,
do you remember that?
I do remember that. I'm sure that she's feeling...
It's an important moment in my career. It's something I always remember.
How do you feel about Giselle?
Future's up 0.5%. That's how I feel about Giselle this morning. She's a married woman. Lisa, behave yourself.
I know.
Is she on the
Come
piano?
on.
Is she
Look,
on
I
the
can-
piano with Francine?
And Tom Brady will be joining too, Tom.
Okay.
It's going to be a fascinating panel.
They're a gorgeous couple. Come on.
Beautiful. I've got nothing negative to say. I haven't got anything. Where are you taking this?
No, I'm just saying, it's,
Good. Stop being mean about Giselle. 317.52
Do you take
on
that
a
personally?
10-year from New York. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Effectively, what the market is saying is you might hike now, but you're going to have to start cutting much sooner than in prior cycles.
With the U.S. Fed raising interest rates, everybody is now expecting a recession.
If we do have a recession, it's likely that it would be on the shallower end.
As earnings swing this time around, we will see an overall level even higher than we do from the levels that are already high.
Now's a decent time to begin tiptoeing back into equity markets for long-term investors.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us on a Monday. John Farrow with us on a Monday, back from sabbatical, and we are going to get out front on what we see in this final week of the second half, and we're going to do it, John, looking at the earnings ballet. Costin of Goldman Sachs with a terse note, and now we see his sell-side team adjust stunning adjustments in their retail outlook.
Let's go through that adjustment right now, Tom. So Goldman cutting the price target at Target, Lowe's, Ulta Beauty, Home Depot, Walmart, Restoration Hardware. Really take your pick this morning. Off the back, perhaps, of David Costin's work going into the weekend last week over at Goldman when he said the following: declining consumer spending represents a threat to earnings for consumer discretionary stocks on autos. And Tom, maybe that's what we've got in store in the months ahead.
And just Restoration Hardware is a beleaguered company, John, and you're the only one I know who actually reads a catalog cover to cover. But I look at RH as a challenge that it's been as a business for years, but they go from 308 as the target, and McShane takes it down pretty much to where the stock is right now. Goldman Sachs with that one story saying it's going nowhere. Is this market going nowhere?
It plays into the biggest story, I think, for a lot of investors right now. We've seen this correlation, this inverse correlation between bond yields and equities, pretty dominant last week. Right. Yields down, stocks up. But we've got to get into the why of it. Why were yields down so much, Tom? Off the back of recession fears or the hopes that inflation has peaked? Now, if it's the former and not the latter, you've got a very different story emerging in this equity market in the months to come. And Mike Wilson of Morgan Stanley out front on that, really saying there's earnings risk here through the next few quarters.
To me, Lisa, what it talks about is quality. You've got the auction today. Which is it, 5-year, Lisa?
5-year, yeah.
Seriously, I mean, it's quality. Full faith and credit, America. Everybody wants to buy it. I'm sure it will go well. But the quality issue witnessed FedEx last week doing so well, and yet here are selected retailers, Goldman Sachs, saying they're going nowhere. Maybe quality is the theme forward.
Or staples versus discretionary. How much is that really going to be the driver in a recessionary environment? Or I'll take it one step further. How much is this a period where equities may actually suffer more than the underlying economy for the first time? A sort of turn on its face. One line from this Goldman Sachs report stuck out to me. Slowing consumer spending represents a greater threat to U.S. equities than households selling their stocks. This has to do with margin pressure, and it has to do with households that can sell those stocks in order to get some benefits, but that might actually cushion them during the downturn, Tom.
And, you know, John, let's go to Home Depot, which is not Restoration Hardware. I mean, they go from a 356 down to 309, and that's a good place to start the data check today because equities follow on from the good feeling last week. Goldman Sachs going the other way.
Building on the gains of last week, we're up by 0.4% on the S&P. Futures positive on the Nasdaq 100 as well, up 0.5% there too, up 62 points. Yields just a little bit higher as well by 5 basis points now, actually, pushing 320 on a 10-year at 317.71. I think euro dollar's where it's at this Wednesday, Tom. Euro dollar 105.70, just sitting around together to hear from President Lagarde, Chairman Powell, and Governor Bailey in Sintra, Portugal. Can't wait for that later this week with Francine Lacqua.
Stephen Gallo with a note out moments ago, BMO Capital, and he says, look, the bet is on strong dollar. He's looking at maybe a short squeeze on yen. I mean, is maybe one way to go here, but I agree. It's just sort of a nudgy is expressed through the foreign exchange market. Brent crude 113.89. Lisa Hornby with us with Schroders, head of U.S. multi-sector fixed income. Lisa, do you hide in full faith and credit?
I think you definitely want to have some of your risk allocated to pure U.S. Treasuries right now. You know, while we may have a little bit of a tactical bounce just given how much things have underperformed in credit recently, I think the path of least resistance from here is still tighter financial conditions. So I think you want to have a decent amount of liquidity in your portfolio.
Lisa, with that in mind, what's the risk that we still haven't fully realized? Is it the earnings story? What is it?
I think the market is, I mean, you guys were kind of talking about the correlations between bonds and equities, and I think it's really relevant here. The market is still gyrating between, is it a recession story or is it an inflation problem? Which one do we have? And as you see, I do think that the narrative will turn towards it's a growth problem. We're going to be heading into a U.S. recession. We're not quite there yet, which means bonds and equities, that those correlations can be a bit unstable, and I think you need a greater risk premium afforded to riskier assets, and credit would be a part of that. So for us, it's lower duration credit when we take it. I think the 3 to 5 year part of the market, credit market, investment grade looks attractive, reasonably attractive with the break evens there, but it's higher quality generally, it's liquidity, and it's not taking a whole lot of risk right now because I don't think we're in a spread compression environment for the foreseeable future.
How much volatility do you think we have to tolerate through the rest of this summer? Lisa, it's been amazing to me to see how much a narrative changes on a single data point within a data point. When did we ever used to talk about UMIT's reading of long-term US consumer inflation expectations? When did that move the bond market by 5-10 basis points in either direction, set the tone for a Fed that might go 50 or 75 at any given meeting? When did it come to this?
And that's the problem, right? Until you can figure out, or until the market can coalesce around where the risk-free rate belongs, how could we possibly decide on a path for riskier assets? You almost need to get some stability in that rate forecast before you can see any stability elsewhere. And I don't know how you want me to measure that volatility question, John, but I think it's more. I think the answer is more volatility, continued volatility, until we get some certainty that these inflation readings are going to start to trend downward.
So, Lisa, if someone were listening to this entire program, they would have heard Kristen Bitterly make the argument that you don't want to be in cash and that you need to be fully invested, because if you miss just a couple days, you miss an entire 8%, 10% return, and it really is the winning moment. What is your argument against that in your quest for liquidity?
I think it depends on who you're managing money for, what asset class you're managing, what your targets are, right? At the end of the day, we manage fixed income portfolios, and these are meant to be, in many ways, the ballast, the sleep at night portfolios for people. So we perhaps have a different risk budget and sort of target than Christian does. But yeah, you can't have all liquidity, which is why I suggest a decent portion of your exposure be allocated to some of these really high quality investment grade companies at the short end of the curve, where you can earn a 4.5% yield. Over the next couple of years, I think that's going to be a positive real return trade. It's going to take some time to get there, but I think we will be paid and rewarded for something like that, and it gives us the opportunity to sort of hide out and wait and wait for better opportunities to emerge.
So, Lisa, when you say liquidity, how much is just pure cash?
Well, pure cash is hard if you're managing relative return portfolios, but I would say, you want a decent portion, double-digit portion of treasury exposure across the curve. So we manage relative return, so we're benchmarked to the Barclays Agg in most portfolios, or many portfolios, and so that means we want a high-quality liquidity overweight, whether it be treasuries, agency mortgages, some combination thereof. Cash itself for us is hard. If you have an absolute return portfolio, then certainly cash is a better option.
Lisa, thank you. As always, Lisa Hornby there of Schroders. And Tom, the issue at play here, as you know, is that the Sleep Well portfolio of 10 years ago has kept you up at night over the last few months in a big way.
While you were gone, John, this was a continued campaign of mine, and it's got nothing to do with Lisa Hornby's wonderful analysis there with Schroders. It's an industry analysis, how people are looking forward with higher coupons, and they're not looking at the most crushing bear market arguably in modern history. I mean, you literally have to go back to, I'm going to suggest the 19th century to see something like this, and maybe I have to go back to 1947 or 1952, but I'm sorry, a sleep at night blended Bloomberg total return portfolio is down 12%. How do you make that up in the bond market? You don't do it by sleeping at night.
So, Tom, the pain here, is it just the scale of the move that we've seen in bonds alone, or the fact that we've seen it in bonds and equities together that gets your attention?
I don't do the together bit. I just think you have to look at them separately, and they've got their own story. Witness the Goldman gloom on the American consumer this morning. But in the bond space, it's off Fed and off this massive fiscal impulse, off a once-in-a-lifetime pandemic. Truly a once-in-a-lifetime pandemic. And the fact is there is just terrific harm in fixed income portfolios that none of the pundits are talking about. They're all looking forward with a more ample coupon right now. How do you make up 12%, or Lisa, help me here, make up 18%?
You should see the Bramo cam right now, Tom. Lisa has things to say.
Well, I mean, honestly, how could you say yes? It's been completely painful and people are looking forward. If they're managing fixed incomes, they throw the baby out with the bathwater, or do they say, okay, we're actually earning income now? It took a lot of pain to get there, but that's the argument here, which is understandable. I do take your point that there are losses that people need to claw back, and that there are certain, whether it's certain assumptions for certain pensions, or particularly insurance companies, they're going to face some issues. However, this does present to some people, depending on whether you believe in the low growth story, an opportunity. I take your point that there is serious pain, Tom, and this idea that it's not the safe instrument that it was believed to be for so many years. That, I think, is something that everybody would get on the same page
Can
with.
I just bring you this news on Credit Suisse?
Please.
Convicted of failing to prevent money laundering by a Bulgarian cocaine trafficker in the first ever criminal conviction of a major Swiss lender in the country's history. The fine, Credit Suisse will be fined 2 million Swiss francs over the conviction, according to the court. No way you're laughing. Credit Suisse will appeal the decision. They take note of the criminal court decision. 2 million.
2 million.
Okay. Futures at 0.4%. I will be staying out of that one. Tom will be too. And
Yes.
Lisa
Well,
has
Lisa
some
will
thoughts
not
she
be
may
staying
share
out of it.
a little bit later. Yields up
No, I think
7
I'm bowing
basis
down.
points, 319.60 on a 10-year from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. For the first time in a century, Russia has defaulted on its foreign currency sovereign debt. That's a culmination of Western sanctions that shut down payment route to overseas creditors. The grace period on about $100 million of interest payments due May 27th expired Sunday. Still, given the damage done to Russia's economy and markets, the default is mostly symbolic for now. The U.S. will provide Ukraine with an advanced missile defense system. It's called NASA-MS, a medium to long-range surface-to-air missile weapon. It's the same system the U.S. uses to protect the airspace around the White House and the Capitol. Currently, Ukraine can knock down only a fraction of the missiles that Russia launches. A new poll suggests that a majority of Americans disapprove of the U.S. Supreme Court's decision overturning the constitutional right to an abortion. According to the CBS News survey, 59% oppose the ruling, including 67% of women, while 78% of Republicans support the Supreme Court action. 83% of Democrats disapprove. And shares of Spirit Airline are lower today. Frontier Airlines raised its offer for the low-cost carrier, earning a recommendation from proxy firm Institutional Shareholder Services. Shareholders will Thursday whether to accept Frontier's $2.6 billion offer on Spirit or a competing $3.7 billion offer from JetBlue. And coming up at 11:40 New York time, we'll talk with Frontier CEO Barry Biffle here on Bloomberg Television. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
The front-loading of interest rate increases is a good idea in this situation, because what you would like to do, if we can, is nip inflation in the bud before it gets entrenched in the economy, get inflation back down toward 2%.
St. Louis Fed President Jim Bullard there at a UBS event in the past week. The next stop for this Fed, July 27th. Looking ahead to July, the 13th CPI in America, on the 14th earnings from JP Morgan. Equity futures right now, positive 0.4%. We still need to close out June. The Nasdaq 100 up 64 points. We're positive by 0.5%, and yields higher by now 5 basis points on a 10-year, 3.1828% on a US 10-year yield. And to round things out for your TK crude, WTI 108.17, call it 15, up by 0.5%.
124 down to 114 on Brent crude here over the last couple weeks. I would point out, folks, if VIX doesn't play this morning with green on the screen, 28.21 is up a stick right now. We'll see how that adjusts to the opening. We always adjust to the good conversation with Javier Blas. He is with Bloomberg Opinion, but that barely describes his impact on hydrocarbons worldwide. Javier, I get out the old Saudi chart, our Arab light. I adjust it for inflation, and we're really getting back to the sustained higher prices that we saw inflation adjusted in the 70s and the 80s. How important now is the sustained price over of being above $100 a barrel for a long time?
I think it's very important. Sometimes we focus on what is the peak price during a crisis, but we don't really remember how long prices were above a particular level. I think that right now the really important thing for the global economy is not just how high oil prices go, but how long they stay sustainable. $120 a barrel is putting a lot of inflation into the system, and it's also one thing to for many industrialists, and I have spent the last few days quite a lot of time speaking to CEOs of big industrial companies in Europe. They have penciled a few months of high prices. They thought that this was similar to 2008, a big rally, and then prices were coming down. But they were not expecting very long, sustained prices as we are seeing right now. It's just already 6 months of high prices, and nothing really indicates that the next 6 months are not going to be anything but similar.
The frost date across Europe, across the United Kingdom, with the energy prices they are, it beckons. It's out there somewhere, depending on the latitude, the longitude. Help us out, Javier. Are they going to have enough energy when they get to the first frost date?
I really think that if we have a full shutdown of Russian gas supplies, Europe is going to struggle this winter. I don't think that CEOs, I think that the CEOs actually are getting more prepared than policymakers for what potentially is coming. And I don't think the policymakers had yet really told the population how bad it could get if Russia shuts down gas supplies to Europe, particularly to places like Germany, through the winter. It will not be enough gas, and we will have to decide what we are shutting down. But the whole economy cannot stay open if Russia shuts down completely gas supplies over the winter.
Javier, we've been talking about this for months, and the story has been similar, and the fears have been similar, and yet we're seeing a shift in the narrative if you look at the price. And we've had 2 consecutive weeks of declines in oil prices, the first time that we've seen that going back to April. How much is this actually matched with something on the ground in terms of a pullback in demand?
Well, when you look at particularly the oil market, and you look at the physical market, actual barrels traded, what you see there is a market that is super tight, with prices going up, with differentials climbing and climbing, and price spreads also going stronger. When you look at the futures market, it's really pricing this scenario of recession, and prices are coming down, as you say, over the last 2 weeks. One of those 2 markets is wrong. Either the physical market is really misreading the demand side, or the futures market is really anticipating perhaps too much of a recession. I tend to think that it is really the physical market which is getting it right, and prices in the futures market, Brent and WTI, are just going to come up in the next few days.
Javier, I wanted to finish on something that you touched on a couple of times in this conversation, and it's the difference between demand destruction and demand construction. And that's a phrase that you've used over the last few weeks, because the policy initiatives that we've heard from many governments around the world right now seem to support demand and don't really level with the public about what might be coming in Europe later this year. That seems to be a big, big issue for you. What do you think they need to do right now?
Well, I thought it was a very interesting opinion article by the 3 CEOs of the largest French energy companies, Total, Engie, and EDF, over the weekend in the French media. They urged demand savings, and they urge demand savings on energy right now, not over the winter. I would like to see European politicians and American politicians making exactly the same message. We do need to save energy right now, because in a worst case scenario, with Russia shutting down, we do not have enough natural gas and oil to make through the winter. We cannot wait until the crisis hits us to take measures. The measures need to be taken now in summer when it's easier.
Javier Blas, thank you, sir. As always, of Bloomberg Opinion. Lisa, what a big, big issue for some of these politicians to confront.
How much has Germany tried tepidly to get ahead of this by talking about potentially curtailing gas usage if storage levels got to below a certain level, which they were talking about last week? How much do they have to go more aggressively, and how non-palatable is that message? I mean, can you imagine the United States if they say, you know what, actually what you need to do is just cut back on your vacations, drive a little less, maybe try to work from home. If you can't, too bad for you.
Yeah, I'm not sure how that message would play, Tom, going into the midterms for this White House. through the
it
summer
won't
into
play in
later this year.
America.
Not at all.
I've seen some of it in Europe, maybe in the UK. They're making fun of those comments, and I don't think there's anything funny about it in America. John, I have no idea how to pronounce this. I didn't know this. Houston, Texas. This is Houston in Scotland. How do you say that, John? Renfrewshire?
I'm not sure where you mean, Tom.
It's up
I'm
Scotland.
not familiar with that.
It's the first frost date in the United Kingdom. It's
in early
way north
October.
Of where you, but it's in October. I mean, it's not tomorrow. But John, what's your confidence that we get to winter in the United Kingdom, that the energy will be there?
It's a tough one for the UK and for Europe.
Yeah.
And to Javier's point, politically, of course, it's not palatable. It's a very, very difficult pill to swallow. But ultimately, what Javier's pointing out is that they will have no choice. It's not a decision they get to make, that it will be taken away from them later this year regardless. And to Javier's point, Lisa, his words, not mine. He's ultimately making the point that they should do something now while they can, because it's easier to do it now than it is later in the year.
And it's not just his point, it's also the point of executives of the biggest energy companies. They are looking at the physical market, they are looking at demand, and you're seeing that with people looking in the United States even at just simply the inventory is getting eaten down heading into the winter.
Equity futures right now up 1/3 on the S&P, building on the gain to last week. We continue to do that through this morning. Good morning to you all, with the Nasdaq 100 up 1/2%. Yields a bit higher by 5 basis points on a 10-year, 3.1847. Who told you that, Tom?
Response.
Thank you. You've got some incoming.
Renfrewshire.
Okay, good. Good. We back on the rails? We're okay.
Scotch.
Fantastic. I can see Mike McKee at the corner of my eye, which means we probably have some economic data up next.
Or it could be on the avalanche.
This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economic data in America seconds away, about 7 seconds away. Mike McKee joining us in just a moment. Futures positive 0.2% on the S&P, on the Nasdaq up about 1/3%. With your economic data, let's get to Mike McKee. Morning, Mike.
Good morning, John. Well, it's durable goods orders, and these are May numbers, so they're kind of important given the focus on whether or not the economy is slowing. Durable goods come in up 0.7%. That's better than last month's 0.5 and much better than the 0.1 anticipated. Take out transportation, you're still up 0.7. The forecast was for a 0.3 rise there. Now, capital goods shipments ex defense. This is what we look at to see what's going into GDP. What's a proxy for business spending? And it is up 0.5%, better than the 0.3, the prior month, and much better than the 0.2. So it looks like businesses are still spending, which is kind of interesting because in their latest statement, the Federal Reserve suggested business investment had slowed. Capital goods shipments up 0.8%, matches last month and much better than the 0.2. So that suggests that the GDP numbers are going to get a little better. One of the things that we've been looking at is what's happening with second quarter GDP. The Fed thinks it will be reasonable, and the consensus of economists is for 2.7%. But as of last Friday, the Atlanta Fed's GDP Now number was just 0. And so the Fed is kind of in this position of, are we slowing the economy fast enough? Are we slowing it too fast? It's kind of the trouble with having this data. It's backward looking and they don't really know.
That is the issue, the major issue. Just going to run through the price action quickly, Mike. Equities fade just a little bit, the tiniest bit. We're still positive 0.2% on the S&P, up 0.25 on the Nasdaq. Looking at the bond market, yields stay elevated. Session highs on a 2-year, up 4 basis points to about 3.11% on a 10-year, pushing 3.20 now, up 6 basis points to 3.1941%. Mike, you were going through all that economic data. How does this stack up against what we saw from the PMIs last week in America and the ISM we'll see later this week?
Well, this is May data, and the problem you have here in comparing the two is that the PMIs are June data. So again, if you're the Fed, how do you balance the two? The PMIs suggest that we are slowing down in manufacturing, which would suggest a slowdown in orders, but the order numbers were strong in May. How does that translate in terms of how long it takes to go from orders to building something?
Mike, thank you. More data to come through the week. We'll hear from Chairman Powell too. TK, that's pretty decent data, you've got to say, though, as Mike pointed out, it's for May. And looking at some of the data we've had recently, some of that hasn't been great.
I always, the durable goods, and particularly XAir, the one that Mike singled out, John, I look at the 3-month moving average, and I'm sorry, the 3-month moving averages are what you hear when you hear Jerome Powell say, John, on your sabbatical. He started his testimony by saying the American
I've still got 7 or 8 minutes with you, Tom, if you want to squeeze in a word sabbatical a few more times.
We'll pick it up tomorrow.
I don't know if there's a drinking game playing out on the side here that I don't know about.
Well, yeah, there's that too. Kathy Butchonchik joins us right now, Chief U.S. Economist at Oxford Economics. Kathy, I am absolutely baffled by Bullard and Powell saying it's a strong economy. And as Mike McKee just mentioned, Atlanta GDP shows the world's coming to an end. Which is it? Why are we so polarized in our guesstimate of GDP?
Good morning, Tom. Well, we're really trying to digest what the Federal Reserve is telling us, what the reaction function is, right? And what they're telling us is inflation is the #1 priority. They feel we're at full employment, and they're not too worried, as you said, about the economy. They think it's strong, and I think that's right. Right now, the economy is strong. The problem is, as we go forward with more rate hikes and continued high inflation, it's going to slow. The question is, how much does it slow, right? How quickly and to what degree? And I think that's what we're wrestling with. You know, in terms of the current, second quarter GDP, we're over 2% as well. We were higher though. We were closer to 3%. There were some downward revisions, consumer spending, but it's still really strong. It's still strong, count for the second quarter.
How much of this will be booming imports? I mean, imports, rather than consumption. How do you balance those two?
So we've seen both really in tandem, which makes sense. Consumer strong, you're going to see, we rely on imports a lot, not just for the consumer, but also to fill the inventories, which relative to sales got quite low. I think going forward with the consumer slowing and that shift towards services, probably could see some of the gains in imports slow a bit. And even inventories to sales ratio may start to look more imbalanced if sales start to slow as we think.
Kathy, based on the data that we're seeing, where it shows strength in the U.S. economy still, perhaps not for a very long time, but still, what's the bigger risk right now? That the Fed moves too aggressively and torpedoes the growth in the short term, leading to a low growth and even slower inflation paradigm going forward, versus not going quickly enough and getting to the Jim Bullard risk of letting inflation become more entrenched?
Yeah, I think for the Federal Reserve, they see the risk overwhelmingly that inflation becomes entrenched. And I do think that is where the risk is right now as well. What we have seen is inflation has proven to be much more persistent and much more elevated than we all thought. And that's, they do need to bring inflation down because it's not only a problem in the near term, but can become a medium to long-term problem. The question is, can they cool the labor market and cool spending just enough that we don't have a hard landing and a rough recession, and also at the same time bring down inflation? And a lot of the unknowns are supply chain, right, issues there. And we don't know. China is sort of still the remnants of the lockdowns and the impulse of inflation going through the system. We don't really know how that's ultimately going to play out. Our view is, though, inflation will slow along with the economy, and there is a pathway. We agree with Chairman Powell to escape a hard recession.
Well, the reason why I ask this is because the price action today is kind of interesting. You're seeing the long end sell off with yields higher just as much as 2 years, if not more, if you look at the 10-year. And I'm wondering if basically there is a lack of conviction right now, Kathy, in the markets that the Fed has the stomach to really torpedo growth, to really be as aggressive as might be necessary in order to curtail inflation over the longer term. Do you think that that right now is the big underpriced risk that people perhaps are missing?
It's a great question, Lisa, and it's actually one of the top ones we get from our clients. After, are we going into recession, and if we do, how bad will it be? The question is really, will the Fed stay with their fight against inflation, or will they at some point say, okay, you know what, inflation's coming down, it's still sticky, I'm just making up a number, let's say 3%, 3.5%. Is that going to be okay, and then do they want to avert recession? The honest truth is we don't know do we going forward, but what we know based on their comments right now, their action, they really do want to, they have the backbone to bring down inflation, and they see it so important. But you're right, as we get forward and what the market's wrestling with is really, do they want to push us into a hard landing if inflation is kind of trending in the right direction? That is going to be the big question.
Kathy, it's almost like there's two Americas, to take the political idea of John Edwards, and two Americas, and look at the trade balance where there's almost two economies. There's a domestic economy with inflation flat on its back, and there's this trade balance, which is standard deviations away from where it ought to be normal. Explain to our listeners and viewers how the trade balance recovers to normal in the coming quarters. I just don't understand how that process occurs.
So what we saw during the pandemic is the trade balance really blow out to continue new records, and that's because imports recovered much more quickly than exports, and that's really does speak to the strength of our recovery, right? Consumer demand, so we import a lot to cover the strong consumer spending. And alternatively, the rest of the world was lagging behind. Now, going forward, we do think there'll be some rebalancing, but it's going to take a long time. But it will happen. Part of the problem, though, is we have this really strong dollar, and that's not going to bode too well for exports or corporate profits. So it could be that this rebalancing takes a lot longer than we think.
John, I'm fascinated by this in the sense that we're talking about the adultness of quarters and quarters and quarters to normalize, and yet we're predicting a recession by 3 p.m. tomorrow afternoon.
Well, Tom, you know, in many ways, there's not much adult about it at the moment because we're seemingly pricing the next Fed meeting off a single piece of view, Mitch, which I think is a real deterioration in the conversation over the last couple of months.
I agree.
Kathy Boschanches, thank you, Kathy. Wonderful to catch up. I just want to leave you all with this thought from Steve Englander over at Stand Chart. Just as we build on this equity rally of last week again this morning, just a little bit, by 1/10% on the S&P. Standard Chartered Steve Englander saying the following: if the Fed does not see evidence that inflation is turning, it may not welcome unwinds of the tough financial conditions. This is the opposite of the Fed put and basically suggests the Fed may push back against equity market gains. In other words, Tom, a Fed call, not a Fed put.
Well, it could be. I think there's a nudginess here that I've never seen at mid-year. I do want to point out, I saw Stephen Englander's note, John. It was good to see that he's looking for stronger Italian lira.
Okay, what year was that?
No, it's like, you know, he's looking at it right now. I mean, that's, you know, on the Amalfi Coast, that's what you pay for your fettuccine.
What do you think the chances that I'm sitting in this seat tomorrow morning? Or maybe back on that plane. In the next hour, I'll catch up with Lisa Shallett, the Chief Investment Officer at Morgan Stanley
cost now?
Wealth Management. Tom, the flights are ridiculous.
It's like I
booked my flights like 6 months ago, and thank goodness I did that.
You talk about demand destruction. How many?
Well, how much destruction has there been, Tom?
That's the
I
issue.
mean, that's the issue, Lisa. Right. In the next hour, in honor of the G7, I may or may not be wearing a tie or a jacket based on the scenes that Anne-Marie has brought us earlier this morning, Tom. The tie's gone, I understand, for Boris Johnson. The jacket's gone too.
With the threat of more.
With the threat of more. But how much further do they want to take this?
Oh, dear
Grandma?
Lord, we're doing this now. No, it's a whole thing about
Is the tie
Vladimir
off?
Putin. He's
John,
taking
go
the tie off.
G7, John.
All right,
Yeah.
okay.
Oh,
I
dear
can
Lord.
do that.
Doing this again?
We can do that again.
Like, what is this?
We can
All
do
like
that again.
Vladimir
The thing is,
Putin envy on the horse?
I've got another hour to go.
So you need to
I
breathe a
can't
little
put
better?
my tie back in.
Well, the shirt's a little tighter after the amount of
I think I
food
bought
ate
this on the Amalfi Coast, actually.
I feel like I should fix
For those of you
my
on
hair.
radio, we're going G7.
This works. It's the G7 look. I did
It's
that
a
on Real
G7
Yield a
look.
couple of Fridays ago.
I know, you
Some
got
positive
comments.
feedback. Some really positive feedback. Like, don't do it again.
Yeah, I was about to say.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A group of 7 nations are expected to agree on exploring a price cap on Russian oil. The goal is to limit a key source of revenue for Vladimir Putin for his war in Ukraine. Bloomberg's learned that a potential mechanism would work by imposing restrictions on insurance and shipping. One of the banking industry's new female CEOs has landed a new job. Hafiza Guya Erkan was co-CEO of First Republic Bank until January of this year. She told Bloomberg in an exclusive interview that she's now moving to Greystone, a privately owned real estate finance company. She actually sees the backdrop of rising interest rates and a slowing economy working in her favor.
When there's uncertain times and volatility in the markets like there is right now in the real estate market, a lot of the competitors actually go hot or cold. And this is a great time for a financial organization like Greystone with a strong financial position to stay warm in the market and to be able to serve our clients in good times and bad times, and that leads to grabbing market share. So it's actually uncertain times bring great opportunities, and real estate market is presenting one right now.
And we'll have more from our exclusive interview with Greystone's new CEO, Hafiza Guya Erkan, throughout the day on Bloomberg Television and Radio. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Make no mistake, this decision is a culmination of a deliberate effort over decades to upset the balance of our law. It's a realization of an extreme ideology and a tragic error by the Supreme Court, in my view.
A nation galvanized. There's no other way to put it over the weekend. Good morning on radio and television. Lisa Bramlett and Tom King, John Farrell preparing for another property. But really quite a weekend, and I want to say congratulations particularly to David Shipley and Tim O'Brien and all at Bloomberg Opinion. I thought with the leadership of Noah Feldman of Harvard University, Bloomberg was informed this weekend about the raging debates, plural, of our Supreme Court. Owning the high ground on all of this, standing at the top, I should say, of the Supreme Court steps, is Gregory Storr. To say he is Bloomberg's Supreme Court reporter barely describes his authority. Greg, I want to drive a story forward here and not do the look back. Last week, orders. Sandra Lancaster versus Illinois. Adam Martin versus Klein Warden. New York versus New Jersey. I don't know what that's about. Maybe the tunnel underneath the water. What are the orders and why do they matter to Greg Storr this morning?
Well, we're going to get a whole bunch of them at 9:30 today, Tom. These are the Supreme Court saying we're going to take up that case or not take up that case. And there are some really big ones the court's going to be acting on the next few days, maybe today. One of them I definitely want to highlight for you affects the airline industry. The federal appeals court said the airlines had to comply with California's labor laws, including its meal and rest breaks for flight attendants. And the airline industry is telling the Supreme Court, you need to intervene here because that's going to cost us a ton of money and upend the industry. We've also got got some really big cases involving election law and New York's vaccine mandate for healthcare workers that the court could act on today.
To the emotion of the moment, pro and con, can a single justice tilt the orders in a certain direction? And clearly, from a culture war standpoint, that would be centered around Justice Thomas.
Yeah, absolutely, and he, of course, wrote the gun decision on Thursday. Seems like forever ago, but before abortion, there were guns. He is now in a position that he's never been in before, where he is the senior justice in the conservative wing of the court and gets to dictate who writes the opinions. He was the one who decided that Sam Alito would write the abortion decision. He's been expressing, articulating theories for decades that are now becoming law, and he's trying to push the court to go even further. In the abortion case, he wrote an opinion that said, we need to go much further. We need to reconsider rulings involving contraceptives, involving gay marriage. Not clear he's got 5 votes for that, but he's certainly pushing the envelope.
Greg, there's a lot of discussion about the credibility of the Supreme Court and the lack of confidence that certain Americans have with it. Traditionally, the hot-button issues are the ones that are really polarized in terms of their outcomes, but the nuts and bolts of the court is not that way, and that normally there actually are a lot of unanimous decisions and that there actually isn't as much ideological bifurcation there. Is that the same thing with this court when you point to the airlines and other business-related cases?
Yeah, I was talking to some folks last week, and they were referring to the business cases as kind of the place where the court turns to get some relief from these ideological battles. There is still, under the surface, a decent amount of consensus. It's just not in the blockbuster cases that are, kind of causing the earth to shift the way the abortion ruling did. We're going to see some more examples coming up this week. We've got a huge case involving the EPA and its authority to combat climate change. Yeah. The argument certainly suggested that one is not going to be a consensus ruling, but we'll see.
Greg, do you buy into this argument that there is the least credibility in this court that there has been in a long time? I mean, there's some, pretty alarming surveys and statistics, or is this basically run-of-the-mill disagreements with high-pressure, pivotal social issues?
Yeah, I wouldn't say it's run-of-the-mill. The polls show that the court is held in much lower standing than they have been in, since people have been taking polls about the Supreme Court. And that's coming from a lot of different directions. Obviously, for liberals, the substance of the court's rulings are really alarming. But you also sort of look back to those confirmation battles over the last few years. You look at the leak of the draft opinion in the abortion case that, regardless of where it came from, it didn't do much, positive for the court's institutional standing, that somebody there is leaking that out. So the court's taking hits from a lot of different directions, really in a historic fashion.
Greg Stohr, thank you so much for joining Bloomberg Surveillance this morning. Mr. Stohr, of course, leading all of our Supreme Court coverage here in Washington. There's one pending case, Lisa, I don't know if you saw this. I'm looking at the document from last week, orders and pending cases. It's Farrow v. Keene about quoting the Dow Jones Industrial Average.
So you were served.
It's going to the Supreme Court.
He served you while you were in Coney Island, while he was over in the Amalfi Coast. He was having a good time
there he is,
serving his case to you.
Titanic response. For those of you on radio, we're going it's a G7 show here, where Abramowitz is looking very Austrian, German Alps, or wherever they are. What a cushy place they get to go to. I mean, can you believe it, Lisa? Maria Tadeo?
I love it. Every time we have Maria, and then whenever Anne-Marie goes on assignment, then, you start lobbying for a road trip. And then, when they don't go on assignment, you're also lobbying for a road trip.
Yeah, well, the road trips we're talking about aren't nearly as romantic as that, I would say.
I think that the subject matter is not as romantic. And I think what they're facing off is some pretty catastrophic moments and sort of trying to pull it together and come to some sort of cohesion among a very bifurcated time when it comes to economic outlooks.
Can I note here near mid-year, Lisa, 0.57% on the 10-year real yield. It's sort of ebbed back a little bit, in that hope to get normal rates.
This goes to what Kathy Bostanchik was saying, and I think this is an incredibly important point. What is the bigger risk here? That the Fed goes too far and actually causes the U.S. to go into a deep recession, or that it does not go far enough, and there is a protracted inflationary impulse? And that, I think, is the tension here. When you talk about the real yield coming in, that goes to this feeling that perhaps the Fed won't be aggressive enough because they are worried about causing some sort of deep recession. That is the fear you're seeing play out on the margins this morning after that strong data for durable goods.
I'm going to get out in front of where we'll be in 3.5 weeks, which is earnings season.
Yeah.
Of course, with Goldman Sachs, with the markdown on retail today, you really wonder the excitement we're going to see as we get to those bank earnings 3, even 4 weeks out from here. Futures up 4, Dow futures up 8, pretty much unchanged. This is Bloomberg. Good morning.
Welcome to a special Wimbledon update for Bloomberg TV and radio from Tennis Channel. I'm Jamie Maggio. 2 superstars will take center stage at the championships as they both try to make history at the All England Club. Rafael Nadal remains on course to complete the calendar slam after claiming his 14th title at Roland Garros. Victory in London will add a 23rd major crown to his resume and extend his lead over Roger Federer and Novak Djokovic in the all-time list of the slams. On the women's side, Serena Williams returns to tennis after a year on the sidelines as she looks for a 24th major title and to break her tie with Margaret Court in the record books. And look out for a potential blockbuster 4th-round matchup where Serena could face French Open finalist Coco Gauff. And don't forget, Tennis Channel's daily coverage from across the pond starts at 4:30 p.m. Eastern. I'm Jamie Maggio.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Let's get this trading week started. Live from New York City this morning. Good morning, good morning. Looking to build on the gains of last week with futures just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. Is it more than just a bear market rally?
The market could rally for another week or two.
The fundamentals still remain quite strong.
Sell a spike on growth, and I would use it to buy the dip.
The downside case is increased in probability.
There is definitely going to be a slowdown.
There's a high probability that we're in a recession right now.
We're in a secular bear market.
The market will sort of retrace where we were.
It's possible that we've seen a peak.
We're going to have inflation in the U.S. surprise.
We're still going to have strong visibility on the inflation.
There's a lot of opportunities, but I think you want to be careful.
It's semantics whether there's a recession or not.
Joining us now to get a week started is Morgan Stanley's Lisa Shallett and Colin Martin of Charles Schwab. Lisa, I want to begin with you. Big week of gains behind us, more than 6% higher on the S&P. Your thoughts on whether that's more than just a bear market rally or not?
No, unfortunately, Jonathan, I think our perspective is that this is a classical bear market rally. If you look at things, one of the narratives of bear markets is that you actually have to eliminate the vast majority of the negative catalysts. And the single biggest one that is still out there is a recalibration of earnings expectations. We've gone through this period. It's the most radical pivot in central bank history in terms of the speed and magnitude and quite frankly, acceleration of monetary policy. Economists have begun to cut their top-down economic forecasts for GDP, and yet, fundamental company analysts are sitting there like deer in headlights, not knowing what to do with numbers, and we're still looking at corporate earnings expectations that look, depending on what sectors you're looking at, 13 to 15% year over year profit growth off of 2021, which was an all-time high for operating profit margins and for profits as a share of U.S. GDP. We just don't see how we don't get a recalibration here from the analysts that take the E in the pre-E's down.
Lisa, let's build on this. Your colleague, Mike Wilson, wrote the following over the weekend into this week. He said this: falling yields, lower oil prices have lowered the terminal rate for the Fed. Last week, the market took the bullish view, which may last a few more weeks. Perhaps we get another rally from here, Lisa, but ultimately went on to say exactly what you're saying before the reality of lower earnings arrives and the bear market resumes. Now, Lisa, the pushback I got this morning when I put that work of yours out there with Mike Wilson was ultimately, how haven't they brought their earnings down already? And Lisa, I know that you've been thinking about that too. Why is this the case when these issues are so well understood, so talked about all the time, every single morning on programs like this one, across networks like this and others too? Lisa, yet it still hasn't happened. Why not?
Well, I think that there are a couple of reasons. I think, first off, there's no doubt that it is an extraordinarily tough environment in which to forecast. And so, I think that there's a little bit of a wait and see, and I think people are very, very focused on second and third quarter earnings and the commentary by management and guidance. The second piece, and this is a refinement of how reliant bottom-up analysts have become on corporate guidance. It is just horrifying that there's very little proactivity among the bottoms-up analysts to go out on a limb and cut numbers anymore without corporate managements telling them exactly what to do. And that's problematic in terms of, their value proposition to investors, because it's not particularly helpful.
Equity futures right now up 0.25%. Colin Martin, equities last week, great week of gains. Yields on 2s and 10s down somewhere between 10 or 11 basis points on the week. From the surface level, we all understand that inverse correlation between what happened with the bond market last week and what happened with equities, but we need to go deeper. Colin Martin, from your perspective, what was behind that drop-off in yields and what kind of implications does that have, should that have, for risk assets?
Well, when we look at the drop in yields, we think a lot of it came down to expectations that probably got a little bit ahead of themselves. When you look at kind of the trifecta of that really hot CPI report, that Wall Street Journal leakage, and then the 75 basis point rate hike, markets began to price in just this uber aggressive pace of rate hikes, kind of forgetting that an aggressive pace of rate hikes like that can have a negative impact on the economy. And not that we're back to where we started, but when you look at intermediate and long-term yields, we almost are. We're up a little bit this morning, but we're not too far off the levels before that CPI report. And that's been in line with what our base case has been. We expected the Fed to be aggressive to bring down the sky-high rate of inflation that we've been seeing lately. But again, that has negative consequences. And as the Fed and the committee members start to see the negative impacts of those rate hikes take effect in the economy, they should probably slow down that pace. Again, in the near term, we're going to see some rate hikes, but when you look at market expectations of 3.5% or so next year, we still think that's a little bit optimistic, given the challenging economic environment we're likely to see in the second half of this year and into next year.
Can you put some numbers on what that challenging environment actually looks like? Colin, last week the PMIs weren't great. This week we get an ISM. What kind of numbers are you expecting that forces this Fed to have a rethink?
Well, we're going to be paying attention to the unemployment rate to see if we see an uptick there. So far, it's been remaining pretty low, although when you look at initial jobless claims, they've been trending higher. Not at levels that are concerning just yet, but the trend does matter. We're seeing them trickle up, and we're seeing a lot of headlines about either hiring freezes or outright layoffs. So that is concerning. When you talk about the manufacturing outlook, the trend is down. We saw that last week with the S&P numbers. We expect the same with the ISM numbers. I mean, maybe not necessarily a dip below 50 just yet, but again, the trend matters. So as long as we see these concerns there, we think that that could prevent yields from rising too much higher and maybe outright pull them lower. When we look at where the 10-year Treasury yield is now relative to what our expectations for the Fed funds rate is, we wouldn't be surprised if it ended the year a little bit lower.
This is the issue that, Lisa, I think a lot of people have got right now. If you take Fed expectations lower, if they're diminished, we buy into them somehow, equities rally. The issue that I think many people have with that, Lisa, I know you do too, is why are we bringing expectations for the Fed down? And if Colin is right, it's based on weak economic data. Is that a reason to buy this market?
Not yet. Again, I think the Fed is really between a rock and a hard place. And I think we're going to have to distinguish between, whether or not, the Fed is encouraged to slow down because, they're seeing economic slowing and a hit to employment, or if they're actually seeing a genuine slowing in inflation. The fear is that we get into a stagflationary environment where, the Fed's actions do a lot to slow the fundamental economy, take a hit to unemployment, and yet do absolutely nothing for inflation because so many of the inflation drivers are actually on the supply side and emanating from things that the Fed can't control. So is there a scenario out there that says, maybe inflation continues to hover, somewhere around 4, 5, 6%? And, how does the Fed look, the market in the eyes and say, yeah, we're going to slow down. Mission accomplished if inflation is still up at those levels.
That's a pretty worrying scenario to think about. We heard from Chairman Powell address some of these issues last week a couple of times. We'll hear from him again this week. Mike McKee on a very important panel between Chairman Powell, President Lagarde, and Governor Bailey too, later this week on Wednesday, I believe.
Yeah, they tell you that names make news, John, and there's a good chance of that this week as an awful lot of big names are holding meetings, and that includes politicians as well as policymakers. We've got, of course, the G7 meeting underway now. President Biden and the leaders of the other G7 countries are meeting today and tomorrow. Then they go over to Madrid, Spain for the NATO summit, and all this wrapped around the Ukraine war and what that might do to inflation, particularly for energy. Then we have that big panel you talked about with the leaders of the 3 of the biggest central banks in the world and the head of the BIS, the central bank of central banks. weeks. What are they going to be telling us about how far they think they need to go in terms of tightening credit to keep the economy of the world on track and yet at the same time bring down inflation? A lot of data in the United States this week that people can react to. We had durable goods this morning, better than expected after the Fed said that corporate investment had slowed, maybe not so much. We also have the Conference Board confidence numbers tomorrow, which will be interesting because that one's really based on what people think of the labor market. So if that remains strong, that's good news for the Fed. Thursday's the big day. Income spending and PCE for May. We know that retail sales fell, but did spending on services rise? And of course, the PCE indicator is the inflation number that the Fed follows. Jobless claims, you were talking about that, and of course, ISM on Friday, and auto sales. They have dipped. You'd expect that with rates going up. The question at the end of the week we'll all be asking is, what effect is this having on growth? How fast is the U.S. slowing if the central bank is raising rates? The consensus of economists has come down, but it's still for 2.7% in the second quarter. As the second quarter comes to an end, though, the Atlanta Fed GDP, you can see there, at 0. So do we have growth or not?
Not pretty. Mike, thank you. Mike McKee with the latest. We'll catch up with Mike later on this hour. Colin, I wanted to come to you on this. I never thought that the expectations for a Fed meeting around 50 basis points or 75 would be shaped by the University of Michigan reading of longer-term U.S. consumer inflation expectations. I asked this question this morning, Colin. I want to ask it of you. When did it come to this?
Yeah, I think it came to this just a few weeks ago when Powell mentioned it. It's funny, I was on this program with you just a few weeks ago, and we were talking about that, how it went from sort of a sleepy economic number to something that all eyes would be focused on. And we got that last week. Now, we had already started to see yields fall, but when we saw the lower revision last week, it sort of gave the markets a bit of pause and thought, okay, maybe this is good news for the Fed. Although at 3.1%, it's still at the high end of the recent range. But the way we look at inflation expectations, and we hear a lot of headlines about them being unanchored. We don't necessarily think that's the case. Yes, University of Michigan, they're going higher. The 1 year out is very high. If we look at that 5 to 10 year range, it's at the high end of the recent trading range, say post-financial crisis. But if you go longer term, it's really just close to the average. And then if we look at the TIPS break-even market, it's an imperfect measure of inflation expectations, mainly due to liquidity, but they're declining as well. And we're seeing readings both in the 5 and 10 year break-even rates in line with what we saw a few months ago. So we think that's going to be comforting for the Fed and might not prevent them from slowing down in July, but it gives us a reason to believe that they could slow down later this year, not just because of kind of the disappointing growth outlook that I talked about before, but also due to the likelihood that inflation does continue to decline.
Colin Martin sticking with us alongside Lisa Shallett with equities positive about 0.2%. Let's get you at home some movers going into the opening bell. Here's Abby for more.
Hey, John. Well, welcome back. And after last week's big pop for the major indexes here in the U.S., we had a little bit of an extension of it today, but beneath that relatively flat to up surface, let's take a look at two big leaders and two big laggards. Tesla is up 1.5% despite a downgrade or a price target cut, I should say, at Mizuho on disruptions around their China plants. It seems that tech overall is extending last week's gain, so Tesla a piece of it. Axsome Therapeutics up 45%. This, as it seems that the FDA is going to give one of their depression drugs a label. There's a 16% short interest on this stock, so this binary event has clearly gone toward the bulls. Spirit Airlines down 6.4%. Frontier recently basically upped their bid to above $24 per share. It seems more likely that based on the price action that Spirit is going to go for Frontier as opposed to JetBlue's above $30 per share bid having to do with synergies. And then finally, Coinbase down 4.7%. Goldman has cut the stock, John, to a sell. This after a 75% drop. I guess Goldman thinks that more downside is there, even as Bitcoin seems to be stabilizing.
Abby, thank you. A ton of price target cuts from Goldman this morning on a bunch of retailers too. We'll pick up on that a little bit later this morning. Coming up, President Biden in Europe confronting issues at home and abroad.
The entire world is feeling the impact of Russia's brutal war in Ukraine and on our energy markets. We need worldwide effort to invest in transformative clean energy projects to ensure that critical infrastructure is resilient to changing climate.
These are important issues, for sure. I've got to ask Anne-Marie what's happened to the ties at the G7. We're going to do a little bit of that next. That won't be the main part of the conversation, but we'll catch up with AMH in Germany, just around the corner.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
The entire world is feeling the impact of Russia's brutal war in Ukraine and on our energy markets. We need worldwide effort to invest in transformative clean energy projects to ensure that critical infrastructure is resilient to changing climate.
G7 leaders discussing a potential price cap on Russian crude as President Biden reboots efforts to counter China's Belt and Road Initiative after an earlier campaign failed to materialize. Bloomberg's Anne-Marie joins us now from Bavaria, Germany, where the G7 summit is taking place. Good morning, AMH. Walk me through the big things on the table right now and the kind of issues you think they can address.
Well, John, there's a slew of issues when you have these leaders gathering. One, they are still trying to maintain that unity, but there are some rumblings in how they can continue to keep the pressure on President Vladimir Putin, support Ukraine enough, and at the same time make sure they are protecting their own economies. And that really comes to the heart of things when you think about inflation and rising energy costs. When it comes to energy costs, the one thing they are looking at the moment, there's been a lot of different reports, but I'm pretty confident in the officials. I spoke to a number of officials over the last 48 hours that right now there is no oil price cap that they've agreed upon. What it is that they are going to agree to have discussions of an oil price cap. They have to look at the shipping, the insurance of all of this, but the idea essentially would be to be able to keep Russian oil on the market, but make sure that President Putin is not reaping from the sky-high oil prices we have right now. And then, of course, when you're looking at one of the objectives the United States wanted to bring to the table, it really was a reboot and deja vu of what the U.S. wanted to bring to the table at the last G7. And this is really something to combat China's Belt and Road Initiative. And President Biden says that over the next 5 years, G7 leaders can put in $600 billion. They weren't able to do that last year, potentially is able to convince them to join now. But the U.S., through private and public money, they think they could bring $200 billion to the table.
AMH, I've got to get to the question. What happened with the ties in the family photo? Why no ties, no jackets? What is going on with this new look of the G7?
I think think they watched surveillance and they saw you take your tie off a few times. Listen, let's be honest. It is actually very hot here in Germany at the moment. I think they were also trying to just be casual. You know, everyone's been working from home. They understand that there is this casual business attire that's allowed. But then there was this moment, Jonathan, which I'm not sure if the officials realized their mics were caught. They were caught on camera from some of the mics of the press pool. But Boris Johnson said we need to act tough. We need to look tough in front of President Putin. And I believe it was Justin Trudeau, Canada's leader, who said, yeah, bare chest horseback riding. And I think that's where they got this whole idea where we should just be casual and look tough. I think Boris Johnson maybe is trying to deflect some of the headlines going on in the United Kingdom right now.
Maybe. I'm not sure these global leaders look tough without a time. But anyway, AMH had to slip it in there. Anne-Marie, Bavaria, Germany. Thank you. Just getting some headlines from G7 leaders. They will work with other nations on clean energy transitions. They reaffirm their commitment on average global temperature increases, all of that stuff. Fact of the matter is, at home, the pressure is building in a massive way. Lisa Shallett, Colin Martin, still with us. Lisa, energy's been a big part of the rally this year. It's been a big part of the problem for these politicians. Something happened last week, and it's been happening more recently too. These energy names have been getting crushed. They've had great years, but more recently it's been tough. Devon down 15% last week. Marathon down 14%. I'm looking at names like Valero Energy down 12.5%. Other names, Freeport, in the commodity arena, getting hammered too, down by 11% over the last 5 days last week. Schlumberger down by 8.9%. Lisa, big winners this year. They're getting sold. What are you telling people about them?
I think it's too soon. Our perspective is that, we are in a fundamental imbalance in supply and demand in the broad energy complex. It was, 6, 7, 8 years in the making. Obviously, COVID and the Russia-Ukraine war exacerbated it. But in many cases, this has been about underinvestment in the carbon, fossil fuel-based, energy delivery, and an insufficiently fast ramp up in green and clean. And so I think we're going to see material capital spending on both sides of the ledger over the next bunch of years. And I think that this is a viable dip, if you will, in the energy sector. Our work shows us that, you don't have sector leadership that lasts, 2 or 3 quarters. This is a buying opportunity in energy.
So you want to buy the weakness in energy stocks. Colin, can I get a final thought from you on what's happening in credit? Some people might say this is part of the recessionary fear, that this is getting sold because they're worried about growth and ultimately the demand won't hold up. Are you seeing anything like that in credit?
Yeah, we are seeing some cracks in credit, Jonathan. I think what's interesting, if you just look at last week, for example, really big rally in stocks in the S&P 500, up 6.5% or so for the week. Look at credit spreads, especially high yield credit spreads, down about 5%. And if you look at historical relationship about, weekly changes like that, big gains in stocks versus what happens with the high yield market, you would have expected to see high yield spreads fall a little bit more, but that wasn't the case. With, a 5 basis point drop is not much when you look at that market. So we are concerned there as borrowing costs rise and as we see a challenging profit outlook, and that could lead to higher leverage levels, and it can have negative impacts on interest coverage ratios, especially anyone with floating rate debt right now. I mean, you're likely to see borrowers who are issuing in the loan market likely to see their interest expenses double over the next 6 to 12 months. So we don't think now's the time to get in just yet. We acknowledge that a yield of about 8.5% looks attractive in absolute terms, but we do think we can see spreads rise a little bit from here, and there might be a better opportunity down the road.
Colin, good to get your thoughts. As always, Colin Martin alongside the brilliant Lisa Shallett. Your equity market positive about 1/3 on the S&P, trying to build on the gains of last week. Coming up in your morning calls and later, the Wall Street showdown continues. We'll discuss what to expect in the second half of the year with Exotic Capital's Peter Cicchini. From New York City, this is Bloomberg.
SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Away from the opening bout, just about holding on to this morning's gains. The S&P up about 1/3%. That's the price action. Here are your morning calls. Three of them, starting with Mizuho, cutting its Tesla price target down to 1150, expecting factory disruptions in China to limit unit deliveries next month. Needham downgrading Etsy to hold, pointing to a challenging macro environment along with elevated inventory levels. And finally, Goldman cutting its price targets on a number of retailers, including Walmart and Target, highlighting persistently higher inflation and tighter monetary policy. That's a story we'll pick up on in just a moment. Coming up on this programme, Wall Street's biggest bulls and bears reiterating their case after stocks record one of their best weeks of the year. That conversation up next with Exonics Capital's Peter Giacchini. The opening bout just around the corner.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
23 seconds away from the opening bound this morning. Good morning to you all. Building on the gains of last week, monster gains on the S&P. We're up another third of 1% on the S&P 500. Futures on the Nasdaq up 0.4% on the Russell. The small caps up about 0.4% as well. From New York City, your opening bound rings. Switch on the board and get to the bond market. Looking at 320 on a 10-year. Yields pick up again after falling last week. We're up 7 to 320.35 on a 10-year. Your high of the year. 349.65. That was the middle of June. That's when yields peaked. The equity market on the Nasdaq bottomed 2 days later, and since then the Nasdaq up about 8 to 9%. We'll talk about that in a moment. In the FX market, euro-dollar 105.82. Looking forward to hearing Francine Lacqua sit down with Chair Powell, President Lagarde and Governor Bailey in Central Portugal on Wednesday. What a panel we've got coming up for you. And in the commodity market, we're down about 0.2% there. About 30 seconds into this, let's get you some movers at the open. Here's Abby.
Well, John, we do have that mildly bullish start that you were just talking about. The S&P 500 now up 4 out of the last 5 days. And of course, last week, as you've been mentioning, one of the best weeks of the year. Let's take a look at what's working. And of course, you were mentioning Tesla climbing, despite the fact that we had the Mizuho price target cut. Investors looking past that, up 1.7% after last week's nearly 5% gain on Friday. Tech is definitely working. Energy is working too. This after big declines last week, but today we see the likes of ExxonMobil climbing by 1%. Last week, some of the base metals, John, the worst week in a year. Today, you have the metals and the miners trading higher. U.S. Steel up 1.8%, now 1.9% on the idea that China is going to be a big rebound source. And then Nike up ever so slightly. They report after the bell, options implying an 8% move up or down. And of course, on the last quarter, John, China was a big influence. Let's see whether or not that happens again.
Abby, thank you. 90 seconds in, we're up a third of 1% on the S&P. Information technology up around 0.4%, higher yet again, extending its gains to a third day following its best weekly advance since March. On the West Coast, let's get out to Ed. Morning, Ed.
Yeah, good morning, John. Certainly momentum in the technology sector, up by 0.4% on the NASDAQ 100. Some of your mega caps, Apple, Amazon, Microsoft, pushing those names higher along with semiconductors. Yields has been a really important part of this story. The pullback in yields certainly was a driver of that tech momentum. As you said, best week since March on the NASDAQ 100. Last week, up 7.5%. We are higher on the US 10-year Treasury yield by 7 basis points this morning, but we're nowhere near that 3.5% mark that we were at just a few weeks ago. And of course, that coincided with a lot of pain for the technology sector. You also look at some of the weightings, right? And when we focus on the S&P 500 in particular, big tech and the weightings of big tech, a very big part of that story. But then it's a double-edged story. There's two sides to it because we've also seen valuations come down significantly. You see a name like Meta there, for example, which has experienced a lot of pain year to date and had big impact on the index. There's now some evidence that value buyers are coming back in, right? Maybe the growth buyers are not there, but the value buyers certainly are. I'm thinking about that stock in particular because I believe last week it hit its cheapest level ever relative to earnings. So maybe there's an opportunity to buy there as we see those valuations come down, driven higher by the pandemic, John, to more reasonable levels.
Ed, thank you, mate. We'll catch up a little bit later through the week. Looking forward to doing that. Ed Ludlow there on the West Coast on big tech. From big tech to big banks, the financials trying to extend their gains after recording their best day in nearly 18 months. Taylor Riggs joins us now for more. Morning, Taylor.
Good morning, John. And finally, some back-to-back gains here for the financial sector. Coming off of Thursday afternoon, we got the good results here out of the stress test. It wasn't a big surprise, but finally gave the sector something on which to trade, basic fundamentals, right? And so you're sort of seeing those gains extend that we had on Friday into Monday as well. And I think this could be some good news here as you're finally coming back and trading on some of these fundamentals, but also given the relative underperformance for the year. As we know, the whole overall sector year to date, if you change up the board, has been off about 17-18% or so. Coming into some of those stress test results, you had been a big underperformer. You're trying to sort of get back up to where we were on the S&P, but still sort of underperformance here as we await maybe approval of the buybacks today. So that's some more news that we could potentially trade off of. I think if you flip up the board, one thing we've also talked about has been the huge yield story today and some concerns maybe perhaps of maybe another inversion, the duration, the length of that inversion on a 2s, 10s, you name it. coming off, though, with some steepness that we had on Friday, has sort of given some relief to this sector. But that yield story really here is in focus here, given some of the financials performance.
Taylor Riggs, awesome, as always. Looking forward to the close a little bit later. Taylor Riggs from Main Bostic, Caroline Hyde, guiding you through that a little bit later. You will have noticed that there is a bit of a battle, unofficial battle, between the strategists over at Morgan Stanley and JP Morgan. What happens at Morgan Stanley is they usually publish over the weekend, coming into Monday, and it's usually, let's just say, somewhat bearish. And then you hear from JP Morgan, usually from Marko Kolanovic on the Monday at some point around lunchtime into the afternoon, taking a very, very different view, being much, much more bullish, of course. This from Mike Wilson over the weekend. He said, quote, falling yields and lower oil prices have lowered the terminal rate for the Fed. Last week, the market took the bullish view, which may last a few more weeks. That's a key point from Mike Wilson. Before, though, the reality of lower earnings arrives and the bear market ultimately resumes. Kaylee Lyons joins us now for more. Hey, Kaylee.
Hey, John. Yeah, the basic thesis here is that this bear market rally can go on for some period of time, but not indefinitely. He essentially says when you take a look at the technicals, a retracement of 38 to 50% of the losses we've seen this year would not be out of line with prior bear market rallies, which could lift the index up to the 4,200 level, or upside of between 5 and 7% from Friday's close. But the warning here is, he says, while the bear market may feel like it's over the next 2 weeks, it likely isn't. In his base case, which is a soft landing, he sees the S&P bottoming between 34 and 3,500, so as much as 13% below its close from Friday. But in the case of a recession, he sees us going all the way down to the 3,000 level. Now, Marko Kolanovic, on the other hand, as you know, a steadfast bull in contrast to the bearishness of Mike Wilson, also thinks stocks could go higher in the near term. His reason is the buying of pensions and sovereign wealth funds as they rebalance their portfolios at the end of the quarter and the month. So he thinks stocks could actually gain 7% this week. And it's worth noting that in most of the quarters, the worst quarters for the S&P 500 since 2007, you have historically seen stocks rising in the last week of the quarter. But of course, a rally of, say, 4% on average, as we've seen over the past years, only goes so far to undo the damage already done to stocks, with the S&P down about 18% year to date. And of course, the pain hasn't been limited to equities. Bonds selling off too, with the 60-40 portfolio heading for its worst first half since 2008, John.
Brutal. Kaylee Lyons, thank you. And a few more days of the first half still to go. I mentioned Marko Kolanovic over at JP Morgan. This is what he published last week. Here's a quote from it. It's not that we think that the world and economies are in great shape, but just that an average investor expects an economic disaster, and if that doesn't materialize, risky asset classes could recover most of their losses from the first half. That's their big call going into the second half. Joining us now to discuss is Peter Cecchini of Exonic Capital. Peter, great to catch up as always, buddy. Let's start there. That JP Morgan view, do you believe the bar is really that low? That, quote, investors expect an economic disaster, and if that doesn't materialize, risky asset classes could recover most of their losses from the first half?
Good morning, John. I'm glad you put your tie back on. That's why I'm wearing mine. Yeah, no, look, it is really a matter of context here. You know, the battle between Mike and Marco is an interesting one. You know, at Exonic, we've been very much in the sell the rally camp along the lines of Mike's call. Sentiment really was washed out, let's call it last week. If you looked at equity market breadth, for example, you had whether you looked at the NYSE or you looked at the S&P 500, for the S&P, only 20% or so of the companies in the S&P 500 were trading above the 50-day, and a like statistic existed for the NYSE. And historically, that happens very rarely and is usually followed by what we agree with Mike is a bear market bounce. So I do think the situation was at an extreme relative to sentiment. However, and I've said it to you before, there's really a secular context which needs to be considered. That is to say, you know, we've seen already the end of a 40-plus year secular bull market in the bond market, and that's meaningful. So not only do we have these secular forces, or pardon me, these cyclical forces in the form of inflation, inflation really that the Fed can't do much about, right? Because it's supply side, it's energy driven. But within the context of this 40-year secular change, and I think that creates a very tricky backdrop for risk overall. And so very much think this is a situation like the 1970s where the equity market's not bearing what we believe is a bear market bounce as well, will experience more downside, not unlike the 70s.
Bit of downside this morning, about 9 minutes in, just to keep everyone up to speed. We're down about 0.1%. We faded those gains pretty quickly. I want to pick up on something you just said, Pete, and I think this is so important. Mohamed El-Erian said something recently on this show too, and I just wonder, when you think about that secular shift, do you think we've realised the policy shift being undertaken here associated with that, and for how much longer that stance is going to persist? Because there are some people that think a lot of this stuff from these central banks is temporary, that ultimately we go back to the old playbook of 10 years ago. I'm not sure many people have actually moved away from that, so I'd love your thoughts on it, Pete.
Yeah, well, I mean, you know, as much as Chairman Powell likes to dismiss it, the conversation around the neutral or natural rate of interest is a big part of this. You know, it for years was really sort of an arbitrary 2.5%. And, you know, you've heard sort of starting to bleed into the conversation the fact that it is lower now, and it's lower for lots of different reasons, but it's also, it's lower because the Fed has been cutting and cutting and cutting. And if you go back to the 1980s, early 1980s, when Volcker hiked, the Fed in each economic contraction was unable to raise the Fed after the contraction is done, rates have been cut. During that normalization period, the Fed has been unable to raise Fed funds back to where it was before. And so I think that's really important observation. And right now, unfortunately, John, you know, not unlike Mohammed, you know, we've been arguing that inflation was non-transitory, that the Fed should act. Obviously, it's wildly behind what the Taylor rule prescription would be for interest rates, and I don't think it will ever get there. And now we still have a situation where rates volatility exceeds equity market volatility by quite a bit. And we just don't think the Fed is going to get to a 4% terminal rates. And you know, even the euro-dollar futures curve, which is implying cuts in June of 2023, is probably not aggressive enough relative to when the Fed's going to have to cut.
So, Pete, you're anticipating some pain. So let's talk about that economic pain you think we're going to get. We got a hint of it in the PMIs last week, and I stress, I should emphasize a hint of it, not a whole lot, but it's starting to come through, and you can start to see it. We get the ISM a little bit later this week. Goldman have come out this morning and cut their price targets on a range of retailers, including Restoration Hardware, Target, Walmart, some others as well. These conversations are things we hear about all the time, Pete. And what we've experienced with some of the retailers, I think, is that we've been reminded that a story can be well understood but still poorly priced. And I'm trying to understand what that means for earnings as they kick off with JP Morgan on July 14th, I believe. Goldman's Costin, David Costin, wrote the following: high inflation and falling asset prices have begun to strain household finances. He went on to say, going into the weekend, the decline in consumer spending represents a threat to earnings for consumer discretionary stocks and the autos industry group in particular. Now, the pushback I got when I start talking about this, Pete, is that we know all this. Why would we be surprised when we see it in the earnings? But, Pete, do you think we will be surprised when this comes up in the earnings story potentially in the next month or so?
Well, a ton to unpack there, but I think you led with the answer to your question, which is that information can be well understood, but not priced in. Or I should say, facts can be known, but not well understood. That's the way I like to phrase it, because of perception. And frankly, that's what makes markets. And you know, one of your colleagues, I believe it was Elena Popina, I hope I'm not getting that wrong, but she wrote a story, I think this morning, on how stock analysts are about as bullish as they were right before the sell-off in 2001-2. And I think that's really important. I think there is a cadre of bottoms-up single-name stock analysts that have really never seen this sort of a setup. And in fact, you know, to their credit, this is the 1970s. None of us have really lived through exactly this situation. Not that this is exactly the 1970s, but anything similar to it. And I think the next shoe to drop, John, is earnings. And you know, PEs have started to contract because of the cost of capital and higher rates, but I do not think earnings have been well understood. And then lastly, you know, you mentioned Restoration Hardware. You may recall that the CEO of Restoration Hardware was one of the first to actually call out higher costs and pressure on margins. And so no one should be surprised relative to that, but seemingly everyone remains surprised.
Pete, we're often surprised. I'm surprised by how people are surprised, but I won't use that word too many times this morning. Peter Cicchini is sticking with us. Coming up, central bankers meeting in Portugal in hopes of manufacturing a soft landing.
There is a possibility that it can be pulled off without a major impact, but it's a narrow path, and certainly we cannot discard the possibility of a hard landing.
With equities just a little bit lower this morning, that conversation up next.
Diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Important right now is for the actions that the central bank to persist and enact forcefully in a flexible way. There is a possibility that it can be pulled off without a major impact, but it's a narrow path and certainly we cannot discard the possibility of a hard landing.
That landing strip about that wide at the moment for that soft landing. That was Augustus Carstens there of the Bank for International Settlements, setting the stage for a big week ahead in Sintra, Portugal, with Fed Chair Jay Powell, ECB President Christine Lagarde and Bank of England's Andrew Bailey meeting in Sintra to discuss the outlook for monetary policy and sitting down with Bloomberg's Francine Lacqua. Mike McKee, I don't know about you, but I can't wait for this. That's a big lineup.
Yeah, it is an all-star lineup. The heads of 3 of the 4 biggest central banks in the world, plus, as you mentioned, the head of the Bank for International Settlements, often called the central banker to central banks. Augustin Carstens made the point that everybody is going to be asking and hoping to get from these leaders when they are speaking there. How far and how fast? We know they're tightening credit to try to bring down inflation worldwide, but how far is each one of them going to go, and how fast do they need to get there? So far, Bailey's Britain is leading the pack with the most increases, but the U.S. Fed has now jumped ahead in terms of the highest rates so far because of those 50 and 75 basis point moves. We're still waiting for the ECB to move. They say they're going to do it in July. The question is by how much, and then how far do they think they have to go? Second biggest question for the panel, John, of course, is can they do it? Can they answer Augustin Karsten's? Can they do it without any kind of recession? Now, no central banker is ever going to forecast recession for their country, but can they tame inflation without inducing recession? I'm sure Francine will ask. Whether or not the answer is unlikely. But Augustin Karsten said it well. How far can they go, and how easy will it be? Or actually, should phrase that, how difficult will it be?
Mike, I'd love to hear about the FX channel, to have the three of them together and to find that tension between them. Ultimately, they can't all have a strong currency, that's obvious. But at the moment, you've got a situation where Governor Bailey, I imagine, wants one, President Lagarde needs one, and Chairman Powell has one. How important is that FX channel to tackle, which in many cases is imported inflation?
Well, imported inflation, you could benefit if you have a stronger dollar because you're buying cheaper imports. But the problem here is that it has different impacts on different countries. The United States is pretty well insulated. If the dollar went down, it wouldn't be as big a deal as it is the euro falling for a very export-oriented economy. And Great Britain, caught in the middle between two powerhouses, has a problem with the same thing. So they will talk about it, but there isn't much they can do about it. It's kind of hard to disentangle because as you're raising rates, you're in theory adding strength to your currency, but you're not doing it deliberately, so not much they can do except maybe tell us what they think is going to happen.
Mike McKee, awesome. Looking forward to it later this week. One for the diary alongside a ton of economic data as well. We sold the open this morning, that's for sure. The S&P down 0.4%, the Nasdaq 100 down about 8 or 0.9%. We're pulling back in the bond market. Yields were higher. They're still higher, just not as high as they were about 30 minutes ago, up by 2 basis points on 10s to about 315, call it 316 on a 2-year, up about half a basis point now to 3.07%. I want to go back to Peter Cecchini of Exonic Capital, the Director of Research, just briefly. Peter, I wanted a final word from you on the bond market. This bond market on 2s topped in the middle of June 14th, about 345 intraday. Your view on how you'd gauge when this bond market has topped, ultimately in a world where you expect this Fed to start moving in the other direction sometime soon?
Yeah, well, you know, to be honest, you know, the move has been surprising. You know, we got well ahead of the need for the Fed to pivot. But, you know, when we hit 3%, you know, I thought we were close to done. So when we hit close to 350, I just didn't think we'd be able to sustain that for as long as we did, frankly, because I thought we'd get a risk off that was even more severe. I think equity markets in particular are very sensitive to the rate market. And if you recall, 2018, we got to about 325, and equities couldn't handle it and frankly forced the Fed into a corner after that, you know, December Powell speech where he talked about autopilot. I think we're in a similar situation here, and I think that long end move is relatively done, and the curve's going to get flatter, and it will invert as we continue to risk off, notwithstanding this bear market bounce, and start to see the economy slow into the end of the year.
Is that a constructive view on the long end of the curve or a less constructive view on the front end of the curve? What delivers that flattening?
Yeah, no, great question. You know, twos surprised us as well relative to how high yields have gotten. But I think 10-year yields will move lower because of the risk-off in equities, which will result in a reflexive flight to quality, while 2-year yields will remain relatively stable because, as I mentioned earlier, we simply don't think the Fed's going to be able to get all the way there before equities risk off and before the economy shows the sort of strains of the tightening that the markets do for the Fed.
Pete, keep the tie on. It looks good. I'll try and do the same. Peter Cecchini there of Exonic. Thank you, buddy. Good to catch up. Equities down about 1/3% on the S&P. On the Nasdaq, we're down 0.7%. Your trading diary is up next.
what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
25 minutes into the session, we do decline. We're off the lows, though. We're down about 0.25% on the S&P. We south some of last week's strength, if you want to call it that. We're down by 0.6% on the Nasdaq. That's the price action. Here's your trading diary. Big week ahead. President Lagarde speaking later from the ECB forum at 1:30 Eastern. President Biden traveling to Spain on Tuesday for the NATO summit, plus Fed speak from San Francisco President Mary Daly. You'll hear from Powell, Mester, Lagarde and Bailey, all speaking on Wednesday. Plus, we get US GDP as well. US personal income and spending alongside US jobless claims on Thursday. And finally, rounding out the week with a big data point, the ISM manufacturing numbers coming up on Friday. From New York, that does it for me. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over.
Connection lost.
They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. and it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venegold as an opportunity to leave that troubled home. Venegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics gets more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up. Because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data to make better predictions.
If you look at the big impacts we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
Garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Teching right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this.
I made the options video where I was like, options are just like shopping.
Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price?
And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people